Hey everyone, John Henry here with School of Trade, and today we're going to be talking about the 3 keys to proper trade management. So, when you're looking at trade management, there's a lot of things that you need to consider, but there are 3 primary things that you need to really concern yourself with. The first thing is going to be risk tolerance. The first thing you need to do is you need to take your account size and multiply it by 3%. Now, this is going to tell you what your goal for risk on each trade should be. Now, just as a side note, smaller trade accounts, such as a $2,000 trade account, they'll often need to go up to a 5% risk per trade, just because the account size is a little bit smaller. And this is one of the reasons why smaller accounts struggle sometimes to make profit. They have to risk sometimes too much on each trade, and only a few losses can blow the account out. Basically, the less risk, the better. If you can get down to risking 2%, 1%, half of 1%, you're going to be much better off. And you got to think of the numbers behind this. If I'm risking 3% of my account and I have a positive expectancy of, say, 70% of my trades, I know that 30 out of 100 trades, they're going to be losses. And if I'm only risking 3% of my account, well, I'll be able to absorb those losses on the way to making those 70 other trades, which are going to be winners. So as an example, a $5,000 trade account would risk $150. That's 3% on each trade, which means basically a 15 ticks of risk on crude oil, gold, Russell. Any market that trades $10 a tick would be 15 ticks of risk. The next thing that you want to take into account is the risk reward. Once you know your risk tolerance to your specific account size, you need to make sure that each trade you take has the proper risk reward ratio. And it's really pretty simple. I want to risk less than my expected reward. I don't want to be risking, $700 to make 100. It just doesn't make sense. Yeah, your accuracy is going to go through the roof because your risk is huge and your target's pretty close, but you might hit 9, 10, 11, 12, even 90 wins, but those 10 losses that you get hit with are going to put you right back in the red again. So the big thing that we strive for is risk reward ratios that are greater than 1 to 3, meaning that we're going to risk $100 to make 300, or 10 ticks to make at least 30. Now, assuming we have a 70% positive expectancy on our trades, we'll take less than 30 losses or so, sometimes around 30 losses, and 70 winners for every 100 trades we take. And I want to make sure that the losses we take are small. Again, going back to that risk reward, and that the winners are large. I want to make a huge, well, not necessarily a huge amount of money, but a big chunk of money on the winners and lose, a really, really small amount. This example would result in making profit above the amount of the losses. So as an example, you risk $100, you earn $300. That means that 30 losses, again, 70% accuracy, 30 losses at 100 means that you lost $3,000. 70 winners at 300 each means that you made 21,000. Now, take 21,000 minus the 3,000, your net profit on the account's 18,000, and that's why risk reward is such a huge, huge deal. Now, the other nice thing that kind of comes with it, especially if you're using a smaller stop, is you can take a couple swings at each trade. You don't need to, take one trade, oh, it didn't work, I'm done. Your risk is so small that you're allowed to take a couple swings at each trade, because you know that one winner is going to cancel out basically 3 losses, sometimes more depending on your risk reward. Now, the next thing you want to concern yourself with is the position size. So now that we know how much we want to risk per trade based on the account size, and we know that we're risking 1/3 of our reward on each trade, now we need to adapt each entry pattern we get for each trade. Now, although we use the same entry patterns to take each trade, usually each pattern is slightly different. Each one's not going to look identically the same. So one size doesn't necessarily fit all when it comes to your stop loss on each pattern. Now, because your stop loss will be slightly different in each trade is going to have different amounts of risk, so you need to adjust your position size. Now, remember, we only want to risk 3% of the account, so we'll use a $5,000 account as an example with a max risk of $150 per trade. Again, that 3%. So an example for position size on crude oil, gold, Russell, any of those $10 a tick markets. Entry pattern 1. We're going to be requiring a 5-tick stop loss. Okay, and on that 5-tick stop loss, that basically means that on one contract we're risking $50. I can risk $150 per trade, keeping again that 3% risk on that $5,000 account, meaning I can take this trade with 3 contracts, because 3 times $50, remember we're using a 5-tick stop loss, is $150. So I can fit in 3 contracts in that trade. Entry pattern number 2, as an example, requires a 7-tick stop loss. Well, the 7-tick stop loss, although it isn't that big, is $70 per contract, and I can only risk 150, meaning that I can't trade 3 contracts anymore. It's too much. I can only trade 2, because 2 at 70 is 140. I come in just under that 3% mark, so I can only take 2 contracts instead of 3 on the second example. Now, in the third example, it requires, say, a 10-tick stop loss. And a 10-tick stop loss, again, $10 a tick, so $100 per contract. I can risk 150, meaning that I can only really trade 1 contract safely, because 1 times 100 is obviously 100, and out of 150, I can't fit another contract in there. So 2 times 100 is an example, or 2 contracts at a 10-tick stop, that's 200, that's over my 3% risk, my 3% risk area. So keep this in mind. If you've got questions, you can always send an email to support at School of Trade. But the other thing that you want to keep in mind is, as a member of School of Trade, you're going to be trained on proper risk management, trade management, position size, as well as the trader psychology to avoid the common pitfalls that happen to most new traders. Managing risk is the most important aspect of your trading career. Not fancy indicators, bells, whistles. None of that junk really matters. You need to protect your capital, and you need to stay alive so you can master the skill, and then you can prosper. So again, don't forget, if you have any questions, you can send an email to School of Trade, and don't forget to check out our trial at schooloftrade.com, and you can also register for our nightly newsletter at schooloftrade.com as well. Have a good one.